Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Wednesday, July 8th. Today on the show, we have got inside reporting on how Tesla has changed its rollout strategy for robotaxis in Miami as it tries to expedite launches. We also have exclusive reporting on Nvidia's new growth strategy, taking a collaborative approach with fast-growing chip startups. We'll then unpack HubSpot's reversal of a controversial decision involving customer data. And finally, we're going to close out the show with a conversation with UBS about what is ahead for the AI IPO pipeline. It's going to be a great show, so let's get right on into it. Tesla is quickly expanding its robotaxi rollout, but it is making some changes on the ground with respect to how it plans to start in new cities. Our Elon Musk reporter, Grace Kay, reported exclusive details on those changes. I want to bring her on to share with us what she knows. Grace, welcome back to the show. It's great to have you here.
Yeah. So the Robotaxi launched in Miami on Friday. And it's looked kind of different from other launches.
So tell me, it's sort of interesting. I mean, they have rolled it out before. Texas has been the main state, I guess, for the rollout, right?
Yeah, they initially rolled it out a little over a year ago in Austin, and then they've kind of expanded into Dallas and Houston.
Okay. And so how is the Miami rollout being different than from the Texas rollouts?
Yeah, so the Miami rollout was the first time they've rolled out in a state without starting out with a safety monitor, which is someone who would sit in the passenger seat and kind of oversee the vehicle, during the early release. And in Miami, they just released it. There was no one in the car, completely driverless. They also kind of in the lead up to it, I found from talking to some sources at the company that like there was a smaller test driver team in the city leading up to the launch. So a year ago when Tesla launched in Austin, they had more than 300 drivers. In the weeks leading up, they brought in people from all across the country that they were working with to test out the area for the Robotaxi. But that was much smaller in Miami, which was an interesting development and kind of like an evolution of of their work with the Robotaxi.
And so the fleet of drivers, I guess, what exactly was the role for these drivers when they launched in a new city? They were meant to what? Supervise the robotaxis from inside? Was it meant to just be there as a safety precaution? Like, what was the role of these people initially?
Yeah, they kind of have a dual role. So before it launches, they have test drivers who go to these cities and they, validate, they test out the software in different scenarios. How does it react to construction zones or, maybe this really difficult turn on this one street, in the city. They do a lot of that work. And then after they launch, initially in Austin, they had people sitting in the passenger seat and a lot of them had their hand on this button on the door that opens the door, but they had re-engineered that button so that it was an emergency stop button for the vehicle. So they were just kind of an extra safety measure when they first launched in Austin. And when they launched in Miami, they launched without that and with a little bit less testing leading up to the launch.
Okay, can we just talk about how funny it is have for a driver to have their button on the door? Yeah, I mean, it sounds like an emergency exit, in some cases, which is kind of
Yeah.
a funny sight. It's like get me out of here now, pronto. But okay, so they've cut the number of people then that are doing these testing rollouts. What's the reason here for this decision?
Yeah, I mean, I think it's just kind of we're seeing how Tesla's process for deploying the robotaxi is evolving over time. Obviously, Austin was the first place that they rolled out, so maybe the strategy has changed a little bit there. It's also kind of reflective of Elon Musk's kind of view for the robotaxi. He has said that like he wants the software to be able to deploy without having to test everywhere it goes. So he wants the cameras and the AI system to be able to figure out roads that it's never driven before, on the first go. And, obviously they did have test drivers in Miami in the lead up, but like maybe having less is kind of another step towards that.
Hmm. Do we know if there have been any issues with the rollout, given that they have sort of taken a more streamlined approach to this launch?
I think it's too early to tell because we're only a few days into this. I think we'll know more in a few weeks or a few months. It's also important to note that it's like a very small area in Miami. It's about 10 to 14 miles. So much smaller actually than when Waymo launched in the city, and Waymo has since expanded to over 100 miles. So, it's a little bit easier to control a robotaxi in a small geofence like that.
Have you sat in both a Waymo and in any of the robotaxis at all before?
Yeah, I've ridden in Waymos, I think in Phoenix, and then also Tesla has a ride-hailing service in California, which is kind of separate from its robotaxi service, and I've ridden in that as well.
And what are the initial reviews, not just from you, but from other customers on how the product performance differs between the two companies? I mean, put aside the fact that you need a driver in the car with you in California. For those robotaxis that are autonomous, or do they live up to the Waymo reviews so far?
Yeah, I think so far the reviews have been good. I think the main complaint people have had with Tesla's service is some pretty long wait times, especially in California where they have to have someone behind the driver's wheel. Um, and part of that is just like there's this huge operational effort to have they call them AI operators, but like the people who, sit in the front seat in California, they have to hire those people. They currently have almost 2,000 people registered in California for that, and they're still having, relatively long wait times.
Hmm. Grace, as you think about the reporting questions that you would like to pursue in this story going forward, what are the big ones that come to mind?
Yeah, I mean, obviously, I'm very interested in how they continue to scale. I'm interested in how quickly they're going to be able to deploy in other cities. And there's also this role that I think is very interesting. As they go driverless, they have these remote operators who are kind of like the safety line. So even though there's no one in the vehicle, they have workers, who can remotely take over the vehicle in these scenarios. And I think it'll be interesting how that comes into play and also to see how Tesla's strategy, which is so different from Waymo, plays out. So Waymo has, cameras, LiDAR, and radar, and they do very extensive mapping before they launch in cities. And Elon Musk, for Tesla has focused its cameras only, and it's this AI system training on the cameras, and they wanna do substantially less mapping. So it'll be interesting to see, like, how those 2 strategies play out and which one wins in the end.
Great. Well, Grace, I want to thank you for coming on. That is Grace Kate, our Elon Musk reporter here at The Information. Nvidia has a new growth strategy that involves partnering with fast growing chip startups. That is according to exclusive reporting from The Information. I want to bring on my colleague Phoebe Liu, our Nvidia correspondent, to walk us through what she knows. Phoebe, welcome back to the show. It's great to have you here.
Great to be here.
Tell me about this new growth strategy that Nvidia is pursuing.
Yeah, so basically, I think a lot of the narrative around NVIDIA's market positioning, I guess over the past few years and how they've been able to really dominate the market for chips that train and run AI has been around how they want to kill competition and kind of talking about aggressive tactics to stay dominant. A few years ago, at least in NVIDIA's perspective, their attitude towards specifically smaller chip startups has shifted. I think starting with NVIDIA's acquisition of networking company Mellanox in 2019, and then NVIDIA's Blackwell architecture that expanded beyond just selling GPUs. NVIDIA has started to basically signal that they're a platform company and not just a chip company. And I talked to NVIDIA senior director Dion Harris for this, and he basically said just that in an interview yesterday. It was like, you shouldn't think of NVIDIA as a chip company. Like, we sell so much more than that. And that shift has kind of coincided with a rise in specialized AI chips made by other companies, including two of NVIDIA's biggest customers, Google and Amazon. And I guess the TLDR of this strategy and my story is that NVIDIA appears to be accepting a future where there are lots of different types of chips in play in AI, not just NVIDIA GPUs, even though they're still dominant and increasing market share right now, according to some estimates I did a few weeks ago. And basically, NVIDIA CEO Jensen Huang has increasingly drummed up NVIDIA's other offerings, so like networking and things like that. I think on one earnings call earlier this year, he called NVIDIA the biggest networking company in the world. Presumably, that's just for AI, but that gives us a sense of kind of how he's thinking. And I guess if there are different chips and increasingly people are talking about the possibility of disaggregating or running the same AI query across different types of chips for maximum efficiency, those chips would still likely run across a GPU because those are still the best for very compute intensive AI uses. And NVIDIA would, of course, love for that to be an NVIDIA chip. So that's kind of the background
Right.
um,
And
under
so
their
so
thinking.
and so
Yeah.
the I mean, the gist of the reporting, the most interesting part is they've actually pursued partnerships then with really not really small companies. They're not tiny companies, but D-Matrix, I mean, this is the
Right.
company that
Yeah.
covered the information for a while,
Mhm.
company that probably fell into the bucket of the, NVIDIA killers maybe at one point, the rivals.
Yeah.
So they're partnering with D-Matrix now. What's going
Mhm.
on there?
Yeah, so a funny story, I think according to a couple of people I was talking to, NVIDIA actually reached out to D-Matrix first, even though D-Matrix is a chip startup founded in 2019. I think they last raised at a $2 billion valuation in November, which is big, but nothing compared to NVIDIA, which is the biggest company in the world, even though their D-Matrix is raising again right now, but they're essentially pre-significant scale or revenue. I think, D-Matrix's CEO, Sid Sheth, said they're about single-digit revenue right now, and it's mostly kind of proof of concept, customers. This partnership with NVIDIA kind of takes that into a real customer, which is Parasail, an AI cloud startup that aims to serve just using AI, not training it, for kind of other startup customers. And basically in this partnership, um, a D-Matrix chip tray can be hooked up to an NVIDIA GPU. So in this case, from the Hopper and soon Blackwell generations. And
And it's
basically,
pretty
yeah,
simple, right? I mean, it's
yeah,
just
no,
it's an
it's
Ethernet cable. It's not that hard of an integration to
right.
do. But how does the
Yeah,
business model work though? So if they're selling this jointly, then do they both generate revenue on a sale of this kind of joint
that's
product?
my understanding. Yes. So I
Interesting.
think, yeah, so they would both generate hardware revenue, and then Paracel will then rent that capacity out to its customers and then get basically rental revenue from that. But the interesting thing is, this is why it works with Paracel's model. They sell based on kind of tokens per second instead of like GPU or D-Matrix Corsair chip dollars per hour. So it doesn't really matter what hardware the workload is running on. Customers are just paying by token. So that's kind of how the business model works.
Tell me, is this common for chip companies to partner with other chip company? I mean, I the way I understood it, and maybe I haven't paid enough attention to it, but customers will take different chips, because
Mhm.
you've got GPUs, CPUs, you need memory, you need all these different chips. Customers will be the ones to integrate all these components on their end. It seems to me that it's rare though for companies to go to market together with joint
Mhm.
products. Am I off base on that?
No, not at all. I think this is a new phase of this kind of disaggregation of running AI, that's really starting to uptick now. Like, no one's really doing it at scale yet. I think NVIDIA really set this off with the licensing deal slash quasi acquisition of Grok.
Acqui-hire.
Yes.
Yeah.
In December, although that business model is a little different because there's a financial component from NVIDIA. But I think that kind of proved to the market that these types of partnerships where you have an NVIDIA GPU running alongside something else that's specialized, usually specifically for very fast AI inference, that could potentially work. There are a couple others. NVIDIA is also working alongside Samba Nova in a partnership that also involves Intel, which I think we reported on a few weeks ago. And there's also a partnership between Amazon's Trainium chips and Cerebrus's chips. All of these are still kind of in the proof of concept testing stage, though I don't think anyone's really using it at scale yet.
Let me ask you a question, Phoebe, here. Do you think that this type of deal is good for chip innovation, broadly speaking, or does it just mean that the big are getting bigger?
Yeah, so I guess obviously just my opinion here. I think because the bigs are so big, it's hard for the small chips to kind of break through without support for the big. So I think this is kind of a helpful type of partnership to help startups actually get more market exposure. At least in my ideal world, I feel like more. I think a few sources of mine have used the phrase co-opetition, and they're basically saying that that helps stimulate the market because making a chip is so expensive and relies so many kind of supply chain strings to be pulled. It's definitely helpful to have someone with kind of a lot of punching power in your corner.
Great. Well, Phoebe, I want to thank you for coming on. That is Phoebe Liu, our NVIDIA reporter here at The Information. HubSpot reversed course on a controversial decision on how it plans to use customer data for its own AI tools. My colleague Kevin McLaughlin, our enterprise software reporter, has the latest on that story. I want to bring him on to share with us what he knows. Kevin, welcome back to the show. It's great to have you here.
Thanks, Akash.
Okay, so tell me about this debacle at HubSpot. What's going on?
Yeah, so this sort of flew under the radar a little bit, but on July 1st, HubSpot sent customers an email basically saying that it planned to use some of the data that they store in their CRM records to power a new AI feature that would make it easier for them to find sales leads. What made this sort of seismic for customers was that CRM data is very proprietary to them, and it takes a lot of work to find it and verify it and clean it up. And so that didn't sit well with customers. And 4 days later, HubSpot reversed course.
What exactly is the tool that they were trying to train? It was like an intelligence feature that took advantage of the customer data here, or what was it?
Yeah, so just for some context, for the last couple of years, HubSpot has had AI powered features that automatically update customer records. Like if their customer changes companies or changes roles, it would update their titles and emails and things like that. And so customers were fine with that because HubSpot told them that it gathered the data to power these features from public sources, third party vendors, sources on the internet. And so it wasn't a case where it was a threat to customers. What changed and what sort of fueled the controversy here was that, as I mentioned, this time around, HubSpot basically said, "Well, we're going to be using some of the details of your CRM data." Now, HubSpot did say that this was only business contact, business card type info, like company names and roles and stuff like that. But it didn't matter to customers because, as I mentioned before, they're very protective of this data.
Right, and the data, I mean, you outlined it in the story, but this data here, I mean, this is kind of these can be years of notes in some cases on customers and some of the secret sauce, I guess that companies hold, right, with respect to all their customer information.
I think it was more than the actual nature of the data that was being used by HubSpot. Was HubSpot actually said that we're going to basically use this information and we may share it with other customers. And so, if you're a
Oh,
HubSpot customer and you spent 5 years sort of pruning your CRM data to the point where it's perfect and it's working for you, why would you want to then have your competitor have access to that data through HubSpot's product, which is of course available to everyone?
got it. So it sounds to me that it wasn't the training part actually was just sort of level one of the concern. It was the potential sharing that was the real concern here.
Yeah, this is a little different. We've seen cases in the past with companies like Slack and Zoom where they had to update their and clarify their privacy policies because sort of internet sleuths looked at their terms and said, "Oh, wait a minute, they're actually reserving the right to train AI models," or at least it appeared that way. What HubSpot is doing is sort of different. They actually did change their terms of service, their privacy policies, and other customer agreements. This was a comprehensive, across the board change. But HubSpot's view was like, "Hey, customers, we're actually like going to make it easier for you to find sales leads." So I think HubSpot sort of misjudged, I think, what the reaction would be. And I think that, as they said in their communications, HubSpot, we're trying to help you, customers, but customers didn't want to be helped in this case.
Talk to me about what you think this tells us about the customer data war story, broadly speaking. It seems like we have these flare ups, I guess, every couple months where an enterprise software company tries something, it gets some pushback, in some cases bigger than others. Was this sort of was this just? It feels like this was actually a step further than we'd seen in terms of what a reversal could look like, in terms of what a customer pushback could look like. What do you make of it?
Yeah, it's pretty rare to see a company backtrack so forcefully just 4 days after implementing a new change. That's one thing. I will say that we've seen many examples. We know that many customers are very sensitive about the way that vendors use their data, and so that's nothing new. And this is definitely there's an element of that to this situation. I think on another level, HubSpot is. One of the hardest hit companies by the SaaS apocalypse. And one reason for that is they sell CRM software to small and medium businesses. One of the things about CRM generally is that it's very hard to switch, especially for larger companies. But for smaller companies, it's much easier to switch. And so HubSpot is a threat on that front. And I think that, given the stock decline, 75% decline over the last 18 months or so, I think they are under pressure to show that they're able to leverage AI to create new features that will bring joy and delight to customers and make them want to buy more. And so I think that there's a multiple dimensions, but definitely a lot of pressure involved in this decision, I think.
Okay, and what do you think the future prospects hold for the company? Do you think it ultimately just gets gobbled up by another CRM company? Do you think maybe uh, I could certainly see it trying to acquire AI companies, but it's not that big a company. You could see an AI company acquire HubSpot too, right?
Yeah, I don't know. Like, I'm
I'm
not
just I'm just brainstorming. Yeah, like CRM,
sure.
it's like it's. I mean, you've got giants, you've got the AI companies touting their own products. Like, what do you think the future of this business is?
Well, there's no question that HubSpot is under pressure and under fire right now. The stock decline and this situation, and we spoke with a couple of customers who said we were already looking to get off HubSpot just because of the costs and the company's practice of sort of gating off features and requiring customers to buy higher level versions of the software to get these features. And so, the company is definitely struggling. I think I think that at some level, like if they are able to develop a hit AI feature, that could maybe change the perception of investors. I wouldn't like rule out their ability to actually reverse the tide. Having said all that, this was not good. This was really not good. I think that the company, the fallout is going to continue. Just trust is so hard to build with customers, and it's so easy to lose it. And I think this is a perfect example of that.
Great. Well, Kevin, I want to thank you for coming on. That is Kevin McLaughlin, our enterprise software reporter here at The Information. Our next segment is with our partner, UBS. It is a busy time for tech IPOs with SK Hynix upon us. Of course, the big question is how investors will view the OpenAI and Anthropic IPOs that are expected to be coming down the pipe in the coming months. To unpack the IPO landscape, I want to bring on Gregor Feige, co-head of ECM Americas and head of Global TMT ECM at UBS. Gregor, welcome to the show. It's great to have you here.
Good to be on with you, Akash. Appreciate it.
So we've got a bit of a busy stint here for tech IPOs. We've got SK Hynix coming up this week. We had Lime and Bending Spoons last week. And then, of course, SpaceX was last month, which UBS was involved in. I saw today, I mean, shares are now trading down below the SpaceX IPO price. And so I just wanted to take your temperature a bit here. I mean, taking all this into consideration, is it an opportune to go public right now for tech companies? What do you think?
I think it's a great time to be thinking about an IPO process. The capital accumulation and formation that's going on in the markets right now is nothing short of phenomenal. You do have volatility in the markets. You're seeing these stocks in the memory space or SpaceX or in technology more broadly moving around in meaningful ways. But you look at the levels that they're trading at relative to where they were 12, 24, 36 months ago, it's a phenomenal time to be considering going public. And we're seeing a lot of companies drive that forward.
Even though SpaceX is now below the IPO price.
That's exactly right. I think there's an expectation that you're going to have volatility as you look at transformation in technology and the sector more broadly, but in the capital markets as well. You're going to see some of those things happen. But the SpaceX IPO, I think was a success. Having it below issue right now is part of the trials and tribulations of being a public company, but a phenomenally successful IPO. Subsequent capital raise they did in the debt markets is a reflection of why companies go public, to have access to capital on a frequent and regular basis.
So let's talk about then the size of that IPO and the size of what many expect to be uh, maybe not similar sizes, but big IPOs nonetheless. OpenAI and Anthropic, they're coming down the pipe. We talked a lot on the show about the capacity for the market to absorb these three big IPOs. What do you think we learned about the answer to that question from SpaceX, and what are you expecting to see from OpenAI and Anthropic?
Well, I think what we've learned is that there is an unbelievable profusion of capital that's out there on a global basis, whether that's sovereign wealth funds, whether that's family offices, wealth, ultra high net worth, and then traditional institutional investors leaning in across the board. You have the largest private capital raise in history with $120 billion for OpenAI, and then an $86 billion IPO for SpaceX, as well as significant capital raises for the likes of Oracle and Alphabet that have all taken place. It shows that there's enormous dollars going behind the AI infrastructure build out that's going on. And SK Hynix, as you referenced, is the next part of that wave. We anticipate there to be a number of significantly sized IPOs. You mentioned two of them with Anthropic and OpenAI, but others that will come and be very large capital raises in the months and quarters to come.
Now, you talked about ultra high net worth individuals, family offices, sovereign wealth funds. I mean, are these pools of capital, have they traditionally participated in IPOs historically, or is this a newer group?
It's newer. It has been a part of the overall IPO process for a period of time, but I think the importance and the criticality of that you're seeing in the capital markets overall, so on regular way equity trading, as well as the IPOs and private capital raises, the quantum of capital that exists in those different pockets is substantial, and it's going to be more and more important as you think about these large IPOs, private capital raises going forward. It's I won't say completely untapped, but it has not been tapped in the way that it will be going forward.
So why are they more willing to invest in IPOs specifically right now in this moment?
They tend to invest very thematically across that group of investors. So they aren't playing for quarter by quarter returns. They tend to be quite sticky as investors. They want to invest over a long period of time and put substantial capital to work. So larger capital raises necessarily are more attractive to them as opposed to smaller cap IPOs that may have more volatility and may not be as thematically oriented.
So when you say, I mean, the themes here, I mean, AI is the big theme here. One question that has been coming to my mind recently is SK Hynix is obviously there in the chip space. We've seen the neo cloud companies also with their debuts. I'm sort of waiting for the application layer of AI to get big enough to then seek capital through the public markets. I mean, if you think about the different pockets of AI, do you think it largely is the infrastructure and chip companies that go public first, and maybe 2, 3 years down the pipe we start to see application layer companies, or how are you thinking about this?
The chip companies and the sort of base layers of the layer cake of AI have been the first to go public. You're seeing that both on the edge side as well as within the data center. That's the core. You've seen a lot go on in the power space as well. The question is timing and sequencing of these things and the scale that's required to go public. There's still a huge amount of capital out there in the private capital markets. And so I think many of the application layers are waiting and going to be part of the next wave that takes place over the course of the next 12 and 18 months. So they're going to come. It's a question of when, and I think they're looking to raise private capital today with high quality crossover institutional investors. We have our private AI conference coming up next week in Menlo Park, and I think you're going to see a lot of those types of companies attending that event, looking to raise crossover capital and ultimately be IPOs over the course of the next 24 months.
And then I guess thinking about this as sort of a matrix here, where you have the different profiles of investors on one side, different profiles of companies on the other side. You mentioned ultra high net worth individuals, sovereign wealth funds, family offices, et cetera. Is that group of capital, I guess, are they attracted to any one particular segment of AI right now? Or like stickiness, is that better suited for a chip company than it is to an application layer company? I mean, how do those calculations get made?
At the end of the day, investors are focused on a handful of factors, right? Scale, growth, profitability, predictability, and durability. All of those are the things that are going to feed in. But growth is really what's driving the valuations and the focus on AI in particular. You need to think of AI in the same way that I think a lot of people would think about technology overall. It's a horizontal, not a vertical. It's something that is going to impact all different industries in various ways. And it's a question for these thematic global investors, sovereign wealth funds, ultra high net worth family offices who want to play in it across the board. They don't want to play in any one. They want to play across all of those and make sure that they're getting access to those investments that are going to be durable, long-term, high-quality investments when you look at what's going to happen over the course of the next decade.
Okay. Now, things are obviously, as you said, it's an opportune time to go public. What would be some of the signals that you'd be watching for to suggest that maybe, hey, companies should pump the brakes a bit on new listings?
I think you'd have to see a pretty meaningful clawback in the markets overall, not a pause in the upward trajectory, but a meaningful trading down and a significant trade off, and investor sentiment declining significantly, which would be a broader market phenomenon. The IPO market typically doesn't close for extended period of times. More than 3 to 6 months is quite unusual. So I think getting prepared now, preparing for yourself to actually control your destiny and be able to go out in the IPO market, should it come more challenging in 3, 6 months, that you ultimately go over the course of the next several quarters and not
Right.
trapped.
But I mean, this kind of gets to the heart of the question. I mean, I mentioned SpaceX as one data point here, but if you look at the last year or two of new public issuances, I mean, a lot of them are trading down below their IPO price, and so I guess what I'm wondering is even that is not enough to signal to companies it's not a great time to go public. So, what does a broader drawdown look like then if we already have companies that are trading below their price?
Well, I think it's an overall market, right? And the time of the IPO is really the critical point. You're raising the capital then. Stocks are going to trade up and down over time based on the measuring of the quality of the earnings and what they've reported as a public company, as well as just how they're growing the business overall. So IPOs trading down is not going to stop people being interested in that next growth story, where you do have the potential for significant, increase in capital and increased in the returns that you have. So we aren't seeing a decline in interest from institutional investors around IPOs based on some of the mixed results that you have seen. But I think the overall markets, you're seeing valuations increase and the prices at which companies are able to raise capital being very compelling for them. And ultimately, the returns are going to come to investors on the back of growth that these businesses deliver.
Great. Well, Gregor, I want to thank you for coming on. That is Gregor Feige, co-head of ECM Americas and head of Global TMT ECM at UBS here on TITV.
Thanks, Akash.
That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, on our YouTube channel, or wherever you get your podcasts. Make sure to follow us on social media, on X, on Instagram, and on TikTok. I'm already excited for our next show tomorrow. Have a great rest of your Wednesday. Bye-bye for now.